Welcome to The Big Break Show, a podcast where we discuss short-term rentals, entrepreneurship, life, mindset, and everything in between. Here are your hosts, Rafa Loza and Jesse Vasquez.
What's up, everybody? Welcome to another episode of The Big Break Show. I am here with my co-host, Mr. Jesse Vasquez.
What's up, my friends? What's going on, Rafa? How are you, buddy?
Not much, buddy. You know, hanging out, dude, chilling, living life. Got a bunch of stuff going on this week, so
yeah,
staying busy.
Yeah, that's cool, man. Me too. Guess what episode we're at today? 28.
28.
Can you believe it, guys? 28. I'm just kidding. But you know what? 28 is extremely special because we have Savannah, who is the Networth Nurse. That's her Instagram handle. She's doing some pretty awesome things. She's a healthcare clinician by trade, but not anymore. She's actually venturing out of that, still working per diem. But she's in syndication now, started with multifamily properties a few years back and has been able to build a relatively awesome career, generating pretty good amount of income for her investors. And she just recently raised, what was it, Rafa, $3 million for her recent project?
Yep, $3 million, which is badass. You know, it's a really good number. Obviously, it's a huge number, and she's doing it really, really well done. In this episode, I asked her a bunch of questions on how she structures the deals, the way her syndication works, and she gave all the details. I love that. A lot of people don't like to give that information out, so
yeah,
it was really cool to know. You guys are really, really going to enjoy this one. I suggest pull out the pen and paper and take some notes on this one for those of you who are trying to get started in multifamily, because she does break it down pretty good.
Yeah, and all you got to do is have money to invest. You don't have to be an accredited investor with her. So if you got $50K to jump in to invest and you want to have, I don't remember what her returns were, 10 to 20% or something like that. You guys have to listen, but that's still pretty awesome. It's fantastic with long-term, and you don't have to be an accredited investor for this. You can just have that cash. So yeah, I'm excited about this one, Rafa.
Yeah, without further ado, Mrs. Savannah,
the Networth Nurse. What's up, guys? We have a super awesome guest today. Her name's Savannah, and she's at the Networth Nurse on Instagram. If you guys don't know her, you should definitely follow her. She's got some really cool things going on from being a nurse at one point. And I think, Savannah, you're probably still a nurse right now, just per diem, I assume. Yep. And she is doing some really cool things in the healthcare world. She's actually teaching. I'll let her explain the story. I'm not going to go in and tell your story, Savannah. So let's introduce yourself. Tell us where you're from, where you started, the whole works. Give us breakdown exactly where you started and where you are currently. So let's go there.
Yeah, totally. So I grew up in Sacramento. I really knew kind of from a younger age that I wanted to go into nursing. I really just had a strong passion and desire to. I had heard about nurses. It seemed like a great career path. I was in different like ROP programs in high school, kind of getting my feet wet with the industry, and I loved it. So really right when I got into college, I started pursuing my bachelor's degree in nursing, graduated with that in 2013. Moved over into Modesto, Jesse's hood for a year, worked at Memorial for a year, as a new grad, and then transferred down to LA. I was working in a couple different specialties and hospitals, and then I was just naturally drawn towards leadership positions, and I was taking on process improvement. And so I went back to school and I got my master's degree in nursing leadership and administration. And so I moved into administration and started climbing the corporate ladder within healthcare. I had a goal of becoming a CNO one day, and that was my huge goal. And I was taking every step to kind of lead me on that path, and was growing. And then beginning of 2020, I had my second daughter, and I was just like, I got to look for a different way to build wealth. My husband and I sat down and we were just looking at our time flexibility with our kids, and we were both worked Monday through Friday, 8 to 5. We didn't have the flexibility to take them to swim lessons and soccer and PTO for field trips and all that stuff. And so we were like, hey, we need to start building wealth. And so when we started learning about different ways to do that, we stumbled upon real estate for obvious reasons. It's one of the best ways out there to start growing wealth. And so when we started investing, we had zero money to start, but we knew that real estate would lead us to that financial freedom that we wanted to. And so we got very creative with our financing, took out a second mortgage on our primary residence to get started, bought a couple single family homes in Atlanta, Georgia. And then after that, started sharing what we were doing with friends and family, and they wanted to start investing with us. And so we didn't even know it at the time, but syndications are an opportunity for people to pool together resources and invest together. And so now we're going out and buying apartment complexes with friends and family, nurses, healthcare professionals I reach out to, and we're buying those to scale our real estate portfolio.
It's a lot to unpack, but I didn't know you were in Modesto. You worked at
Yeah.
Yeah, I used to frequent in that hospital all the time. I was in there on the floors. What part of the where did you work on that hospital in that floor?
Oncology.
You were in oncology. So was that the fourth floor?
Yep.
Yep, fourth floor. Yeah, see, I know this entire 4 South, right? 4
Yep.
South.
For
Oh
South.
my gosh, I know that hospital like the back of my hand. That's super cool. So, healthcare clinicians, a lot of them are not educated, and I guess I'm saying this in the wrong way. They're educated, just not financially. So, was that something that you learned early on, like in your life, with like growing up as a kid? Did your family teach you financial literacy?
No. Me personally, no, not at all. I mean, I never really knew anything about anything. I mean, even when I went to go buy my first home here in LA, it was just a complete cluster. Like I had no idea who I needed to talk to, what I needed to do, lenders, what they did, different terms. I was starting from scratch.
Got you.
So I got some questions for you here because I'm super curious. What made you get into syndication and buying apartment complexes? Did you go straight from learning to invest in real estate into apartment complexes, or did you start off small with like small single families?
So learned about real estate investing beginning of 2020. I had my daughter in February. So by March, April, we were ready to start investing. Um, Took out a second mortgage on our primary residence, bought two long-term investments across the country in Atlanta, Georgia. That was kind of getting our feet wet. We thought we could cash flow, a couple $100 a month. That was good. This is, before I started learning about short-term rentals and all the craziness and more money you can make. So a couple $100 for a long-term rental was like good, right? But we were ready to scale. We did those two deals pretty easily. They were turnkey by build to rent projects. And so after that, we were like, all right, what's next? How do we do it next? And so during the CARES Act, during COVID and everything that was going on, my husband liquidated his retirement account because we were full, set on real estate investing. And so moved into syndications because we wanted to start raising capital. We realized, we wanted to scale a real estate portfolio, but we didn't have the capital. And so we knew partnering with other people, us putting in the sweat equity, wanting to go out there and do it. I love operations. It's what I did for healthcare for a long time. My husband's very, now that we've started learning about real estate and owning and managing real estate, we're very passionate about it. And so we're now going out and buying these properties and people are investing passively with us. And so when we did first start learning about syndications, we went through an extensive coaching program. We spent $30,000 on a coaching program to move through it and get coaching programs are good for two reasons. I think one is the accountability piece. My husband and I didn't need that. We were action takers. Every night after we put our daughters to bed, we were hustling and grinding and underwriting deals and talking to people and sending emails. So we didn't need the coaching program for that. We really wanted it for kind of like the confidence of having someone over our shoulder, looking at all of our underwriting, making sure everything was sound. There's a lot of legal documents that are in syndications when you're handling hundreds of thousands, millions of dollars of other people's money. That's a huge responsibility. And so we wanted to make sure that we were doing everything right from the beginning. And so that's why we invested in the coaching program.
Okay, I love it. So I want to break down a lot of stuff here because I'm currently in the process of doing some multifamily myself, and underwriting, it's what I'm learning, and setting up structuring deals is what I'm trying to get comfortable with as well. So I guess my first question is, were you already underwriting prior to joining this coaching program? Like, were you already kind of trying it yourself, or did you just learn once you jumped into this coaching program?
So we had learned how to underwrite a long-term investment, like just on Bigger Pockets and watching Brandon Turner articulate what's cash flow and what does that look like by looking at your property, mortgage, income minus expenses. So that was the extent of our underwriting that we knew before we moved into multifamily. Multifamily underwriting is another beast. The spreadsheets that are involved in multifamily syndication underwriting are like 15 tabs in one Excel sheet. My husband does all the underwriting. He's like an Excel wizard, but he's gone on to kind of build out his own formulas and software because all the pages kind of talk to each other in terms of like syndicating your returns when you go to sell, different P&Ls, summaries, projections. It's all exit strategies. It's all laid out in there.
Got it. Okay. First, can I ask you how many deals you guys have done in multifamily?
Yeah, 4. So we did a 12 unit and then we went to 24 and 18 and we're closing on a 36 in a week or so.
Awesome. Wow,
Yeah,
that's awesome.
90.
Okay. And can we talk about how you structure your deals with your investors and how you set everything up?
Yeah,
Like general partners,
definitely.
limited partners, everything?
hmm Yeah, so every deal's been a little bit different, but we've structured them all 80-20. So all of our investors get 80% of the deal. Us as the operators in the deal, we take 20%. So the majority of our returns go to our investors, and their percentage is determined based on how much capital they're investing in the deal. And then it's broken down onto total capital needed to close the deal. So it's all formula driven and how much percentage they get of the deal. So we do an 80-20 split. Our investors come in, we start with a $50,000 minimum investment. I've done $25,000 investments for my nurses and my women, but they just want to get in a deal. So I've actually done a few of those, but usually our minimum investment's 50,000, and our goal is to give our investors 100% ROI through the investment period. So 3 to 5 years, we're looking to give our investors their $50,000 back plus another $50,000 on top of that. And that's seen through quarterly cash flow. And then the majority of that comes at sale. So every quarter, every month, we're collecting income on the building. We're paying the expenses. What's left over is the cash flow, and it's split between the investors and operators based on the equity split.
Okay, so on the cash flow side of things, let's say, so whatever cash flow you guys generate, it's 80 for the investors, 20 for you, correct?
Yes.
And that gets divided basically on the percentages of what they brought in. Okay. Do you guys offer any type of equity on the deals?
What do you mean?
Or is it okay? So I guess the question I'm asking is, after the 5-year hold, is it to sell it off, or is it like
Yes.
long-term hold? Because when you sell it off, obviously so you're doing all your deals to sell off.
Yeah. Yes. So we're exiting it at 5 years, and then they'll get their initial investment plus the return of the sale on top of that.
I got a question for you, Savannah. So you know how can you talk about qualified investors, and can you talk about how I'm assuming you guys don't have a qualified investor standard for doing this because they're typically nurses. So you want to break that down for our audience?
Yeah. So in syndications, you'll see different listings. So there's a 506B and a 506C. This is kind of how they're legal securities and how they're advertised and marketed to the general public. A 506C caters only to accredited investors. So there's accredited investors and unaccredited investors. To be an accredited investor, you have to have a yearly total income over $200,000 individually, $300,000 joint filing, or over $1 million in net worth liquidity. Those are usually kind of the two parameters to qualify you for an accredited investor. My husband and I are not accredited investors. We were not when we first started investing. The majority of nurses really aren't. And so for us, we're very passionate about providing opportunities to unaccredited investors. So unaccredited investors, the difference really in the two deals is that a 506C offering for accredited investors, those can be marketed and advertised all over social media, all over the internet. So you'll see those. Ours, because we're a 506B, we can't market it. We need to have relationships with our investors. It's just kind of a securities legal binding. And so if you want to invest in our deals, you need to either have a relationship with us, you need to get a referral, you come onto our portal, you book a call with me, and then you hang out in our investor portal. And then that's where you'll be notified if there's a deal, because I won't be posting on social media about it if I get an investment opportunity.
Yeah, that's a big point because for those of you who follow Grant Cardone, he started off doing exactly what you're doing now, and he ended up going through some huge legal battles because there was a little, like people put in $10,000, that's literally all they have, and they come back 5 years later and like,
Yep.
Grant, I'm not getting my money. And you have like 100, 2,000 people that are wanting their 10 grand. And that's the difference between accredited investor and not accredited investors, that those people that have all that liquidity, like they're okay losing 10 grand. And somebody that puts their 10 grand, that's like, that could be their entire life savings. So that mentality has to go along. And I'm sure that you coach them along with that process. But anyway, I was listening to a podcast with Grant Cardone. He talked about how he switched from just having the average person be able to invest to accredited and only, because he was like being chased down by people that were wanting their money. So is that something that you worry about, or that you're protecting yourself on that end? And do you talk to your investors about the potential of, because with investing, we run our numbers in a certain way and it's not always guaranteed. We try to map it out as well as we can, but at the end of the day, it's still a risk going into it. So can you talk about that a little bit?
Yeah, and that's all laid out in the legal documents. So the legal documents for syndications are pretty extensive. There's a private placement memorandum, it's close to 100 pages. There's an operating agreement, a subscription agreement, and the investors have to review all these before they get entered into the project. So they pretty much are signing an agreement that, they're at a risk to potentially lose their entire investment. Obviously that's not our goal at all. We've always over delivered on all our projections for our investors. So we're nowhere even near that. But it is, it is a risk of investment. And I always tell investors, this is the same type of paperwork essentially that you sign, even when you set up a retirement account where you have $100,000, it's the same sort of risks and you sign off on it. Usually it's just with a click of a button on these online portals. And so you're not reading the verbiage. It's not as scary. But the risks are a lot less with real estate investments than even the stock market. And I always just try and encourage investors who are weary about that to properly educate themselves on the differences.
Let me ask you a question back to the underwriting and the process of setting up, and we know how you acquire your investors, right? As far as when you say that they're passive, is it just because they're providing only the funds and you guys are doing the rest of the work?
Yeah. So our LPs in the deal are limited partners or passive investors. Those are kind of really words that are thrown around very interchangeably. They are very passive. So they are signing in the agreement. They don't have any operating decision-making rights in the investment. They're bringing the capital and then they're sitting back, collecting their quarterly updates, quarterly returns. But my investors love it. That's the part they absolutely love about it. They're not doing any work. Every 3 months, I send them a video with updates on the project, different pictures. I send them their check deposited into their account every 3 months. And then we provide them the financials. We're very transparent with all of our financials. They get full insight into our P&Ls for our properties. And so I have some investors who love reviewing that because they love real estate and learning about it. And I have a lot of my investors, my doctors who just get that check every 3 months and they're like, cool, yeah, great doing business with you. Thanks for the return type thing. So I really do deal with a lot of different investors, but I love education so much. I mean, that's really the foundation of my platform, Networth Nurse, is education. And so we're always more than happy to kind of walk investors through it. I have a lot of first-time investors jumping into my deals.
And what if somebody finds you or brings you a deal? How do you structure that in?
So those kind of partnerships we've just created through people that we've met in the industry. So when you're going out and doing large syndications, there's a lot of different qualifications that don't really apply to single family homes or short-term rentals. There's a loan guarantee that you have to come on, key principles that hold the net worth liquidity requirements. So my husband and I going out and buying these large apartment complexes, young enough that we don't have the net worth and liquidity to necessarily qualify for these loans completely on our own. Most operators don't. Almost all operators in syndications bring on a KP or a K principal just to sign on the loan with them. So they do get a percentage of the general partnership or the GP for doing that. There's so many different ways to structure syndications, but kind of the biggest way to think of it is there's different percentages applied to different roles in it. So in the general partnership percentage, there's usually 4 different roles. The deal finder, whoever's bringing the deal, the acquisitions, finding the deal, getting it under contract, doing the inspection and the due diligence, getting the deal to close. That's the acquisition. They usually take about 15-20% of the deal. Then you have the capital raiser. They take 30% of the general partnership, and this is for bringing all the capital to the deal. If you have multiple capital raisers on projects, which these huge syndications do, hundreds and hundreds of units, multi-million dollars raised, they'll bring on sometimes 5 capital raisers into these huge deals. So then they divide that 30% of the 20%, because remember the whole deal was broken into the 20 and 80. So now that 20% of the general partnership, that 30% that's designated for capital raising, they divide that amongst all the capital raisers. So once you start getting into the weeds of these syndications, the structuring can be a little bit complex for people to understand, but it is pretty straightforward. So you have your acquisitions, you have your capital raiser, then you have your asset manager. This person manages the asset throughout the lifetime of the investment. So our hold period is usually 5 years. So this person takes about 30% of the deal. Then the other 15-20% loan guarantor, key principal, they take about 10-15% of the deal. And then we kind of, in our deals, we combined investor relations with the capital raising. So that's kind of how the general partnership team is made up of different people. And then they're managing that investment throughout the lifetime of the investment. And then as you can see kind of from that scenario, these LPs or passive investors are very passive in the deal.
Okay, that's awesome. Thanks for clearing that up. Yeah, my next question was going to be about the guarantor for the loan. So thank you for answering that as well. So okay, now I'm curious about when you're structuring the deal. Do you guys take a fee up front for bringing the deal together and putting it on the table?
Yeah, an acquisition fee.
Yeah, an acquisition fee. Okay.
Yeah, that's very normal. So for our first deal, we didn't take one because we were just scrambling to find investors and get us into the deal. And so we didn't take an acquisition fee, which was fine. It was our first deal. But then usually investors will take like 5% up to like sometimes 3%. So some of these, like for our latest deal, I think it was like a 1.3 million raise, and we're taking like close to a $20,000 acquisition fee. And so that's for doing all this upfront work of getting the deal, raising the capital, and getting it to close. And this last close, because of everything going on with the lending agency, actually took us like 5 months. So these projects are really big projects.
Yeah, gotcha. Okay. And then one last question. I'm sorry. What about depreciation? How do you guys do that?
Yeah. So cost segregation, a huge benefit of these multifamily buildings. So we didn't do it our first year. And then we did it for 2021 on all of our buildings. So we had 3 apartment complexes, because our 4th one we're closing on this year. So 3 apartment complexes we did cost segregation studies on. And my husband and I have always been high income earners, in the 20-30% tax bracket, getting taxed like crazy in California, handing away 30% of our paychecks at least. And this year will be the first. Our CPA just told us we're going to get a $32,000 check back, which is like amazing. It's completely like, so that's the power of cost segregation. So kind of with that is you're going out and depreciating the building. So there's a lot of write-offs you can do and depreciate assets within that first year. And so it creates a negative number. So all the income generated from the building, you can offset by the depreciation. And so the building kind of shows a loss. It shows that you have a loss of like $80,000. And then you can roll that over to the income year after year. The only kind of disclaimer about this is it really only applies to full-time real estate professionals. So this is something that when I'm talking to my investors, not all of them benefit from these cost segregation studies. We do them on our properties because we do have a lot of real estate investors, us included, who will benefit from the tax incentives of doing them. But if you're not considered a real estate professional when you go to file your taxes, you don't necessarily get all these tax benefits. So it's something that we always encourage our investors to go to their CPA and let them know, hey, I'm going to be investing in a real estate syndication. This is what my returns are going to look like for the year. This is what the bonus depreciation and the K1 will essentially look like. And then it gives our investors an insight when they go to their CPA, and then they can set themselves up so that they're in the best position to receive all those benefits.
Yeah, I think you have to be 70% of your income has to come from real estate in order to be considered. Am I wrong on that? I think that's what my CPA was saying. Or there's a certain amount of hours.
Hours, yeah. So for me, I had to prove that over 50% of my time spent working is on real estate as opposed to my job. So that was a huge incentive for me to quit my full-time nursing job this last year. So I quit it in October, and then it gave me those 2 months of not working. And then, I've been busting my butt with real estate. So the amount of hours that I have is like, crazy. It does offset that, but you still have to, I had to log it all in an Excel document and show it to my CPA just in case for auditing purposes.
I love that. Yeah. Okay. So right now, your first deal, you're what, halfway through the cycle on right? Because you said you started in 2020, was it?
Yeah, we closed on that November 2020, and that's actually a 3-year exit. So we are over halfway there now.
Let me ask you a question. Why not hold on to these long term instead of flipping them after the cycle ends for your investors?
So it really depends on what your investors want. And this is something that operators really need to determine what investors you're catering to. Are your investors looking for a long-term play of a 10-year hold and cash flow? And there's a big chunk of investors that are looking for their return within like 1 year. They want it within the shortest amount of time possible. So we have our first project, that's a 3-year hold. So we're looking at like a 70%, I think 75% ROI for our investors at the 3 years for that first project, which is, perfect for them. We're hitting the over 100% on our 5-year project for sure. So it's a different length of hold. And then it gives investors a different cash flow. So we've done a couple of different strategies, but, and there's ways that operators will do a cash out refi. So, and then they do waterfall splits, which we can really get into the weeds with all this stuff. But some operators, what they'll do is they'll refinance and get a bunch of cash out. They'll cash out their investors, and then the operators will take back all that equity. So now they're really cash flowing. So there's so many different ways you can structure it. For us, it's kind of really been dependent on what our investors want. And we're kind of hitting the sweet spot with the 5-year hold. And then kind of going from there, once we exit on these, we might determine, okay, maybe we'll do a 10-year hold. Because I have a lot of family members jumping in my deals, and they are looking for that long-term hold. And they're kind of like, wait, why are we going to sell this in 3 years? Let's keep it going. And so then we might have opportunities to 1031 into a bigger deal and that sort of stuff. But we try and make it up front with our investors from the beginning of like, okay, this is our goal. We plan to sell at year 5, but it's an asset that we evaluate year after year to determine the best strategy. Oh, does it make sense now to cash out refi and give all that capital back to our investors sooner? Does that jack up the IRR now and it gives them better returns? So it's something that we evaluate really regularly, but it's kind of dependent on the market and different things.
I love how there's so many different ways to be able to structure these type of deals, right? The reason I asked Savannah was because I've talked to so many different syndicators, and I'm actually in a mastermind group with a bunch of dudes that own like thousands of apartments indoors. And I always like picking their brain on how they're actually structuring their deals. And the reason I asked was because, well, I guess before I get to that point, are you doing value add plays, or is it like, what type of buildings are you looking for? Okay, so you're doing value add plays.
Mm-hmm.
Yeah. So the reason I asked that is because the way some of these guys that I talk to and the way I'm going to structure my deals is, when we do the cycle, we're actually going to do just a full refi, give them their money back, but they're going to keep a percentage of the cash flow and a percentage of that equity for life that we hold the asset regardless once they get their initial investment back, right? Which is kind of what you were talking about anyway at the end. So I was curious as to how you were doing it, which is why I asked, why not hold on to them long term? My second thing is you should look into opportunity zones, Savannah. If you guys plan on doing long-term holds for 10 years plus, one of our really good buddies, he was on here, and he just came out on Bigger Pockets also. And he talks about like these crazy benefits. If you buy an opportunity zone, hold for 10 years, it actually gives you a better tax depreciation than a 1031 because you hold it for life, right? There's no having to push it for the next one and having to push for the bigger deal to save on those taxes. It literally wipes them off the table. So just a thought. I'm not sure if you're aware or familiar with it, but it's super, super beneficial.
Yeah, no, I love it. There's so many different ways and different asset classes that you can invest in. And like you were saying, like the value add strategy for anyone who doesn't really kind of know what this is really what we're doing is we're going and finding apartment complexes that are completely mismanaged. So usually elderly sellers, they've had it for so long. Maybe they own a bunch of real estate. They're not functioning it like a business. They're not, operating it to its fullest capacity. And so we're going in there and seeing these assets, the expenses are completely out of control. They're not raising rents appropriately. And so when we're looking at the financials for these buildings, we're seeing like, wow, this water bill is 3 times what it should be. We're going to go in there and implement a huge water conservation program, take out every single one of the toilets, implement high efficiency water flow toilets, all new aerators on all the faucet sinks. We did that on one of our properties, drastically cut that water bill. And we're going in there that most of our owners just like are not raising rents for whatever reason. They have bad property managers in place and they're just not doing it. And so we're going in there and really with like sometimes very minimal work, raising rents 9% year after year for the tenants, which is huge returns when you're looking at like, a 40 unit apartment complex. And so this is how you're adding value into the equity. And then this is kind of what allows you to refinance because you're pushing all this equity into it. Multifamily functions in the lending aspect a lot different than single family homes, where single family homes, you look at all the comps and that determines what your property is going to sell for. A multifamily complex, it sells for what you're bringing in and the income. So it's a mini business. And so you're functioning it based on the cap rate in the area and what income it's generating. So if you're able to push equity, generate huge amounts of income, drop the expenses in these multifamily deals, you're adding huge value add plays. You drastically jump up the returns, and then you're able to kind of flip it almost in like a 3 to 5 year period and take all this equity back out of it.
Yeah, just listening to you guys talk right now, Like I've always been, a single family guy. I'm looking at duplexes now. Obviously, I'm in the short term rental space, but Savannah, like, it's insane how many different ways there are to get into real estate. And once you get in, like, how much more you can actually learn. Like, you're just scratching the surface right now with, you're doing big things. But it's crazy how, like, you're talking about all these things, and the average person that's even in real estate doesn't even know these other principles that you're talking about. So it's, unless you're around people, like Rafa goes to a lot of masterminds, you learn from a mastermind, like you have to like be around these types of people to like start soaking that stuff in. It's incredible to like hear you guys talk about this stuff, because like I said, I'm a noob in that aspect. I'm not even a noob. I'm just like listening to you guys trying to figure out what the hell you're talking about. But
Jesse, you're gonna get there, bro.
That's how I felt when you came on to our meetup and we're talking all your midterm rental, short-term rental stuff and showing all those numbers. It's just like mind blowing when you start learning about all the strategies. Like Rafa, even mentioning the opportunity cost thing, like that stuff you hear, and that's like shiny object syndrome in the real estate space.
Yeah.
Of like, that's the one downside of joining so many meetups and masterminds is you start learning what everyone else is doing. You're like, oh, hell yeah, I want to jump on that. That's what I want to do. And to an extent, like for us, like we really stayed focused. Like we did 4 apartment complexes up in the Oregon market, very similar styles and business strategies with how we play those out. Now that we've done those, we're very comfortable with them. We have it really down to a science. And now it's like, okay, we've gotten that down. You want to put enough focus into a strategy to get good at it before you start learning about other ones. But yeah, there's always so much to learn in this space.
Yeah, you're right. I mean,
Absolutely.
it's crazy when you go to these meetups and you meet people. Some guys doing hotels. They're turning STR hotels, and everybody starts doing that. And then you got somebody else that goes in and does midterm rentals, and everybody starts doing midterm rentals. And it's like everybody's trying to jump all these things. But I think a lot of the time, and if you read the book, The One Thing, it talks about focusing your energy on one specific like niche or one specific market. And that's kind of exactly what you've done with the healthcare industry, like teaching clinicians and being in that space, seeing people that are earning a decent amount of income, and then having that money just sit there. Like the savings account that's an old school way of thinking. And I'm finally excited now that people are starting to shift that, those retirement plans and all those things, like they're starting to invest in different ways. And I've seen it over the last 5, 6, 7 years where people are finally realizing like, holy crap, I can't just leave money in the stock market anymore. We obviously had a good run with the stock market. Now it's not what it was, during COVID or even prior to COVID. But real estate has always stayed relatively in the same space, and it's a long-term game. It's not short-term. In your situation, it can be short-term, and that's one of the great things about real estate is that there's so many different avenues to do it. Like Rafa can arbitrage a place in cash flow today, and then a year from now use all that capital from the cash flow to now buy another property, and then get into syndication a year later or 2 years later with all the 30, 40 properties that he has. Like and you just got to learn. You got to just literally go somewhere and learn. I mean, it's crazy. It's insane.
We talk about this all the time. It's being around the right mindset type of people that want to be at the level where you want to be, or they're at the level where you want to be. I'm sorry, right? When you surround yourself around these people, you're always going to go, man, I can't believe that's possible because I never thought about it because nobody around me ever even brought it up, right?
Right.
Like it's the exact same thing, right? And that sometimes costs money, right? Like for you to learn costs you a lot of money to learn, to take this program so you can get to where you're at now, right? I'm learning by being in a lot of high-end masterminds, right? Being around like-minded people is huge for your growth. It's massive for your growth. Savannah, let me ask you a question. Currently, right now, everybody that you're helping with your syndication deals and your investors, are you taking any IRA money, like any retirement account money from any of them? You are?
Yes.
Okay. So,
it's a huge opportunity for nurses to jump in because most nurses work multiple jobs. They're not usually in one nursing job forever. And so they'll hop around from a lot of different jobs, and they don't even realize that these old 401ks that are just sitting there not doing anything, with the click of a button, you can convert it into a rollover IRA. And then with that, you can convert it into a self-directed IRA, and you can invest in these syndication deals. So yeah, I do have quite a few nurses and other people. I don't only cater to healthcare professionals. I have other people in my deals. So I have other people in there who have invested through their IRA accounts. It's awesome. The only thing I tell investors about that is all the money that you're generating from the real estate investment, it goes back into the IRA account. So it doesn't go into your pocket like it were if you were to invest with liquid cash. That money does go back into your IRA. So if you were to pull out that money, you would still deal with the same sort of repercussions for pulling it out early. So yeah, that's the only disclaimer there.
Yeah, there's some penalties that are attached to those, but that's still like, those untouched IRAs, those are all tax benefits too.
Huge. And I tell people our AAR, average annualized return for our investments, are 20%. In the stock market, historically, since its existence, has done about 8%. So you could double, essentially your money by just with the click of a button, putting it into the self-directed IRA, 8% to 20%, that could grow astronomically over 20 years, the difference in that. So just by redirecting that money into a better performing asset like real estate, which you can do, educating people on that, it's huge. So yeah, big opportunity there.
Savannah, how are you finding your deals?
So we actually did all 4 of our apartment complexes through one broker. We met this kind of in multifamily. That's probably the biggest hurdle when you first start looking at deals and finding deals, is getting brokers to take you seriously, because they have a dozen investors who have a lot of experience, who have proof that they've closed deals. And you have, it's a lot to close these deals. And a lot of times, they do unfortunately fall through the cracks because there's a lot of different moving pieces. And so getting a broker to take you seriously with not a lot of experience is difficult at first. So for us, we probably talked to about 50 brokers across the country. We were still looking at Atlanta, Georgia, Arizona, New Mexico. And then we found this guy up in Oregon, and young, hungry, Marcus and Millichat broker in his mid 20s. And we're I think because we were so specific about what we were wanting, we were like, hey, we're looking for a 12 to 20 unit, $1 to $3 million price point, value add in this sub market. We were so specific that I think the broker thought we knew what we were doing, even though we've never done it before. So he started sending us deals. We started moving through it. We signed the contract. We got to close, and we told him like, yeah, we did our first syndication deal. And he was like, that was your first one? Like, had no idea. We went on to do 3 more with that same broker. So it is such a relationship industry of knowing people, who to talk to kind of get those deals in front of you.
Yeah, for sure. So typically, are you guys looking for like a certain? Because you're telling me they're like it was 15 units to 36 units. Am I correct?
Yeah.
Okay. Is that like your niche? You want to stay with the smaller mom and pop style apartments?
So really kind of our reasoning behind that is my husband and I, usually in this space, a lot of operators will partner with other operators and then they're splitting that GP. My husband and I, the way that we split up the business, we kind of split it perfectly, and he does acquisitions and asset management, and he splits that half of the GP, and I do all capital raising, investor relationships, and I have the relationships with the KPs that sign on our loans. So my husband and I kind of split it 50-50 and do the work. We did that first deal together just to kind of learn all aspects of the business. And then after that, we kind of split up the work. So he is really out. So when we're looking out and going at properties, I'm looking at how much capital I've raised, and that's determining what size building we're buying. Because I've kind of raised the majority, I think almost all the capital for my deal. I brought on a couple capital raisers jumping into the deal with me, but for the majority of it, it's like if I know at a given time, okay, I have $1 million raised right now through my investor portal and all my asset, my software that I use to manage that, then I can go to my husband and say, hey, I have like $1 million. And then now he's looking for properties that are in that range. So that's kind of how we've done it up until this point. But we have potential opportunities to like scale and partnership to grow. Maybe we're thinking.
Savannah, how do you feel pitching to these guys? Like, you have to be a good saleswoman.
That was okay. So when we did our first syndication deal and we closed on it, my husband and I were like, all right, we exhausted the like 3 family members that we had, friends and family. We don't come from people who have money to invest in deals. And so we're sending out emails to friends and family. We got like maybe 2 responses out of like 40, and they moved forward in investing with us. So my husband and I were like, all right, we want to keep doing syndications. Where the hell are we going to find the capital? We don't know anyone who has it. And so that was when we were like, all right, let's partner with the capital raiser. So we started having conversations to partner with them, and we realized, okay, regardless, because my husband and we don't have sales experience. Like I didn't like being in front of the camera. I didn't like selling things. Like that's just so out of character for me. Like seriously, being a manager in healthcare for so long, when any time a pharmaceutical rep would come into my office, like strong hand up, like I know that world. So for me, I didn't want to be that person. I didn't want to be that salesperson, which, now I've come full circle, and I feel like Networth Nurse, my face and brand are everywhere, but it's kind of cringy sometimes even still. But it's a part of capital raising. Like we realized, okay, we're going to build a business. We need a capital raise. I need to be in front of how do you get people to invest money with you? They need to trust you. And how do you do that? You go in front of the camera, you talk about what you're doing, you share who you are, you share what kind of deals you're doing, what kind of relationships you have with people, what kind of education and content. And so that was really the birth of Networth Nurse of, okay, I'm going to create a hub for all my content. Because as I started going and talking to investors, sharing what I was doing on social media, I would get the same questions all the time. Nurses would come to me, how does a syndication work? I don't even know about it. So then I'd create a blog writing about how the returns work. I write a blog about how the syndication process works, a blog about how to invest in your retirement account, how to pull out home equity to invest in a syndication. I have blogs on all this stuff because I've had investors come to me over and over asking the same questions. Now, when I get them, I'm like, hey, check out my blog here. You'll learn exactly how to do that. And so for me, creating Networth Nurse was initially about raising capital for our deals. But now, as I've been doing it and I've talked to so many nurses, I realize there's like a basic financial gap of education for nurses and healthcare professionals, high income earners at the hospital. And I learned this throughout the COVID pandemic of seeing firsthand the financial situations that nurses and doctors were in, high income earners, because they don't invest their money and they don't know what to do with it. So then at that point, after COVID, I became super passionate about just sharing basic financial resources for nursing. And so that's why we have kind of even personal finance courses, how to get out of debt, how to pay off student loans, to really encompass nurses from a starting point to the point where they have $50,000 and they're ready to invest in a syndication.
Yeah, I always talk about sales being so important, and a lot of people don't realize how important it is. No matter what it is you're doing, like it's really important to part. And you're pitching to these potential investors. You have to sell your ideas. You have to get in front of them with the PowerPoint and say, "Hey, here's what we do. Here's the expectancy. Here's what we're the earnings." So it's such an important thing. I think you're doing it in a really smart, intuitive way by putting blogs together, putting those things together, and maybe I think you have a YouTube channel too. I'm not sure if you YouTube those things as well, but that might be an option. I'm going to kind of talk about this real quick because you and I talked about this offline a second ago with Rafa. There was a Forbes article that just came out, a survey that showed 47% of healthcare workers are planning to leave their positions by 2025. 47%. That means nearly
Mhm.
half of all clinicians are
Mhm.
getting ready to leave. So how important now is investing more than ever? Like, if you're looking at that window, of the next 3 years, how important is it to put in, 50 or 100 grand into in a syndication you have to be able to have that extra income, going forward? And where are these nurses even going? Like, that's the other thing is like, what's happening?
Right? So they're leaving. They're getting the hell out of the hospital, that's for sure. And nurses really throughout the COVID pandemic were really abused, and being in management throughout the pandemic, I, was seeing that firsthand of nurses being shown they're indispensable. If you don't get a vaccine, we're going to fire you. You were a healthcare hero a month ago, but now, if you don't abide by our rules, you're out the door type thing. So the lack of support for healthcare workers throughout the pandemic has been very eye-opening. And I think, quite frankly, with the transparency of social media, a lot of nurses feel empowered to leave the bedside and explore different opportunities. I think I read somewhere, like there's been a 30% increase of small businesses over the last couple of years because people are realizing they want to get out of corporate and go out and do their own thing. And so I have seen this. I see this, the travel nurse agency picked up. I think I was talking to one of the educators at my hospital last week. In our cath lab, we have one full-time nurse there. The rest of the nurses are all travelers. These are patients coming into our hospital having heart attacks. There's one staff nurse there that's going to be treating you. The rest of them are travelers. And I'm not saying travelers are not capable at all, but I'm saying from a management background, I've ran departments in a hospital, and running a department with one traveler is a little bit scary as a manager. And so there's a huge shift in healthcare. I'm honestly very curious to watch what happens with it, especially with the travel nurse agency, because hospitals aren't going to be able to pay them this rate. I had nurses in the cath lab here in LA who are making maybe 70, $80 an hour. We're paying the travelers $150 an hour. So now you're depleting your resources on the traveler. They're doing the same work. Now you're making your staff nurses pissed that who's working right side by them, they're loyal to the hospital, but the traveler right next to them, they're not loyal and they're getting paid twice as much. So just kind of I could go on and on about the healthcare. But, I chose to leave in October 2021 because my income that was coming in from my real estate assets offset what I was making from my job. And so now I'm focusing full time on my business. Jesse, I talked to you, I'm applying to venture capital to create an app and do that sort of stuff now to grow my business in addition to real estate. But it has been very eye-opening for healthcare workers. And for me, over the last couple of years, as I've started sharing with them what I'm doing, they look to me and they're like, oh, that's so cool. I want to do it too. How do I start? And so for me, it's just been all about providing resources, education, community, coaching, courses, whatever nurses and healthcare professionals can have, starting that Facebook group that Alex and I have. We have 2,400 healthcare professionals in there that are investing in real estate because they want to start generating income elsewhere. It's made people realize they don't want to be reliant on one place for your income, your W-2 income.
Yeah. And a lot of that too, Savannah, is just education. And I think it's so empowering that you can take that on and say, like, I want to help people. Like, that's so important in a person. I think that you're almost kind of like obligated to do that because you've been able to be successful on your end. And that's how I feel like with myself. And even Ruff have had this conversation where it's like, we've been able to do this. Like, why not teach other people to do it? You know what I mean? Have them be empowered by eventually leaving their W-2 job. So I really encourage what you have going on. I think you're like doing some really awesome things, and we haven't even talked about the venture capitalist stuff, but that's a whole other animal in itself. And I hope you picked up that book, Pitch Anything, because that one right there, that's a really good book. It really breaks down a lot of like persuasive selling and kind of offering the prize and hook points and all that stuff that you go into when you're pitching to these venture capitalists. But yeah, I mean, it's freaking amazing, right, Rafa?
Yeah, dude. I mean, I don't think I get a better feeling than knowing I've helped somebody do something different or new in their life that's helped them get to another level, right? Whether it's financially, whether it's mindset shift, whether it's physically, whatever the case may be. I love when I get feedback from someone that I've helped out and they're like, dude, because if it wasn't because of you, I wouldn't be to this point, right? And it's like, dude, I appreciate that. Thank you. I love that because it's always such a good feeling, right? The more you help people get where they want to go, the more it's going to come back and help you get where you want to go, right? We talk about that all the time. So it's awesome what you have going on. You want to talk a little bit about Networth Nurse exactly and like what other things you do to help people out?
Yeah, definitely. And that was me kind of just like seeing it. I think you get motivated to help people because you see people in these financial situations that are so preventable. And it's like you don't have to be living like paycheck to paycheck, a slave to your job for the rest of your life. And it's just, for me, it was like hearing the way nurses talked about money or investment or retirement. And it was just like, I felt so like it's the golden handcuffs, they talk about it in healthcare all the time, especially with physicians of like, you're making a 200, physician, $800,000 salary and you feel okay, but then the lifestyle creep and you're still living paycheck to paycheck. So moving into the real estate space and the entrepreneurial space, like we kind of talked about earlier of just like the mindset shift of this is different ways that you can generate income in your life. So sharing that with nurses through Networth Nurse has been my biggest passion. So social media is huge. What I do, creating courses was kind of my next step after that, and then kind of creating a community where people can come in. I do some coaching as well, and then down the work, and then we have our investment opportunities at Willow Investment Group, and have opportunities for nurses to invest completely passively, which they sometimes don't even know is possible. That you can receive the returns and returns that real estate has to offer in a completely passive approach in the real estate syndications.
Yeah.
Let me ask you a question about that, Savannah. Because when people think passively, they think they're going to get these like minuscule returns, right? Like, oh, well, if I give you 100 grand, I'm going to get what, $100 a month type of situation. I don't know. So how does those returns look for your investors if they give you, let's say, like 50 grand or something?
Yeah. So we just did our quarterly disbursements. I think my 50K investors, I cut them a quarterly check for like $900 for one of our investments. So it really kind of depends. And then with the syndications and the value adds, depending how much value you're adding, like how low the rents are when you're getting in and how out of control the expenses in. Sometimes the cash flow is pretty low when you're getting in. So sometimes our cash flow is like 4 or 5% on some of these deals as we're getting in, but then we go in, raise the rents, we can jump it up and up. Our deals are structured in a way that it does increase as the years go on and more value is added. But that's kind of just a basic entry point for a 50K investor.
It's pretty good. And you know what? Now I thought of another question really quick. As far as whenever you raise the rents, are people moving out and you have to replace them? And when they do, are you guys doing rehab to the units, or is it part of the value add play to do rehab, or is it just like find ways to lower the operating expenses?
A couple different things. So we have some buildings where we are literally doing nothing and we're just serving our tenants a notice saying you're in 30 days or 90 days, depending. I think it's 90 days. Your rent's going to be raised 9.9%. And then a year after that, and this is in Oregon where people are scared of rent control and landlord friendly or tenant friendly state. We're raising rents 9.1. That's a pretty aggressive. When we underwrite our deals, we're underwriting at about like 3 to 5%. That's how my husband, he just does it very, very conservatively. But obviously, if our property manager is going out there and telling us we can raise it 9.1%, we've done it on all our buildings. Really, as soon as we take it over, send out a notice saying we're going to be increasing rents. The majority of them honestly stay on. So for some of the turned units, turnovers actually present sometimes a good opportunity in multifamily. So if you have a tenant who's paying $800 a month when market rate's like $1,500, if that tenant moves out, cool. In Oregon, you can still raise it up to market rent. California is not the same, but you can raise it up to the $1,500. And for our buildings, we really don't have to do too much work. We've done full turnovers on a handful of units just because we've had long-term tenants who moved out and everything kind of just needed to be gutted. We did have one tenant completely damage one of our units and we had to evict him. But I mean, even throughout, we kind of mentioned COVID in the beginning and then stock markets, but even throughout COVID, we started on our first deal November 2020. We've collected upwards of 98% rent on all of our buildings. So very minimal delinquency. We have less than 5% vacancy rate on all of our buildings. So multifamily is just a very strong asset class. Even in the 2008 recession, it was one of the first to bounce back after that. And we've seen it be really resilient throughout COVID as well.
Got it. Appreciate that. Jesse, any final questions here? I know we're getting to the top of the hour and I want to shift to our segment.
Yeah, I have a lot of questions, but maybe I should save them for the next time. No, I mean, it's just cool watching somebody go from like being a nurse, which you're still a nurse. Wait, you know what? That's my question. Why are you still a nurse right now? Like you don't technically don't have to do that anymore.
I know, but I'm the net worth nurse. I can't give it up completely. I honestly feel like I would abandon a bit of my brand if I were to do it. And I love patient care. Like when I was a manager and having to deal with everyone's problems every single day, even after hours on the weekends, after call doctors and people and supervisors calling me at night. Yeah, not really much. But now that I'm just a staff nurse and I walk in, hang out with my patients, don't deal with any of the other stuff and leave at the end of the day, I love it. Like being a nurse, the conversations that I have with the patients in the hospital, and I was there yesterday, so it's pretty fresh. Like it is the most humbling career like I've ever experienced. The conversations I have with people facing cancer diagnosis, not being able to walk, babies coming in there for cleft palate surgeries, like just people coming in to have surgery. It's the most humbling experience. And I love just being able to hang out and talk to my patients and give them, some sort of lightness in their day. And I really get a lot out of it. So I do it one day a week. I'm not really ready to give it up completely, but it is becoming increasingly difficult with my demand of time.
Yeah. I wasn't in patient care, obviously. I was on the business development side, but I have to go in and talk to patients. And some of the best conversations that I ever had with people were at bedside, like, cause I'd have to go and talk. I was dealing with hospice patients too. I had one guy one time and he's just like, you know what I appreciate? And I was like, what's up? And he was like, I'm going to get emotional about this. He's like, I appreciate the sun on my skin. That's all I care about.
Right.
And it's crazy because like we forget so much of the little things that, our lives are like, we're filled with the daily monotony of just things happening. But like there's so many small little things that happen to us on a daily basis that we should be incredibly grateful for. And one of them is like literally, he just said, I just want to feel the sun on my skin. Can you will me down? I was like, yeah, we'll take you down. That's literally all he wanted. He was a cancer patient, stage 4, knew he was going to die. Boom. I would say. So those are really incredibly humbling, especially you're working with the patients directly. So It's awesome. That's awesome. So yeah, we're gonna jump into a segment. I know that was kind of like a downer, but it's also like a, we're humans. Like,
Nah, it wasn't actually. I'm
I
glad you brought it up. It
know.
wasn't. Yeah, it was really good because it kind of puts you into perspective of like appreciating certain things. You know what I
yeah,
mean?
there's an old Indian proverb, and it's if I remember it correctly, it's like to one man, a man that's like well wants everything, but a sick man just wants one thing, and that's to be like healthy. That could be woman. Man means like woman or man, one or the other. But it's really incredibly true, and I think clinicians really learn that, and they really deal with that stuff on a regular basis. So I encourage. I mean, I think it's awesome that you're doing what you're doing. So we're going to switch over into segments. So yeah, everybody, be appreciative of what you have going on in your life. Like enjoy the sun, feel the warmth of on your skin. I mean, that's
Yes.
awesome. We're human. We're alive. We get to wake up. Especially being in America, we have a bunch of opportunities here. And I think a lot of people forget
Yes.
those kinds of things.
Amen.
So, Savannah, one of our segments here is obviously the show's named The Big Break. And Rafa, I'm taking your speech right here. What was one thing that happened to you in your life that gave you that shift or perspective of a big break? Something that happened to you mentally, or whether it was job opportunity, mind shift? What was that one thing?
Yeah, for me, definitely having my second baby and being like forced to hand over a 3-month-old baby that I was nursing, to go back to a job and being like, yep, I need to get my ass back in the hospital because I need that paycheck. And that feeling, that dread, that deep in my stomach, like I'll just never forget it. It was just like, I have to do something different. Like this will be, I knew if I were going to work in the hospital for the rest of my life, advancing as a CNO, work, I would regret not being there for my kids and having them and then being here and having to hand over my tiny baby to my daycare lady was just like, I need to figure out a different way to do this. So
Yeah, that totally brings. Did you have were your parents around all the time when you were younger, or are they like, is that something that you kind of changed? Like,
yeah. Uh-huh. And although I can't do a stay-at-home mom, I don't have it in me. I love my children to the moon and back, but I could not be the stay-at-home mom type deal. They're 2 and 4 right now. So literally at the Sunday night, my husband and I are like, oh hell yeah, they're going to daycare tomorrow. Like we're handing them, it's kind of shifted perspectives, but they're wild. But no, I have so much more flexibility now. I can leave at half day, go pick them up, take them to swim lessons. I leave at half day to go take them to lunch and go to a park. It's just a lot more flexibility. And then even kids get sick. Like I was thinking about my kids have been sick the last couple of months, just on and off with bugs. And I'm like, if I was in a working in a hospital as an administrator, calling in sick to me was so painful. Like I always felt so guilty, hated it. I'd always be trying to touch base with my caregivers, even when I wasn't there. And it created so much guilt. Now I don't have that.
yeah,
So
well, now you're per diem. You can go in wherever the heck you want. And you decide to work in 2 weeks from now, you just be like,
exactly.
I'm going to work Tuesday on the 4th, and that's it. So that's pretty awesome.
Yep, exactly.
So awesome. So one of our other segments is learn and apply, right, Rafa? You want to break that down?
Savannah, if you don't mind, Learn and Apply is the segment where we want all of our guest speakers to give either the listeners or the viewers an actionable step that they can take once this episode's over, that they can go in and apply into their lives to get them to the next level of either investing, either trying something new, whatever it is that you can recommend to them to do that helped you along your way that might help someone else.
Yeah, for me, it's reach out to someone who's doing what you want to be doing or where you're at, what you want to be doing. And there's a different strategy for everyone. If you want to get into real estate investing, whether it's flipping or Airbnb, arbitrage, it's syndications, multifamily storage, whatever it is, like if you are following someone on social media who's like doing it and whatever they're doing just like really appeals to you, reach out to them, see if they have any advice on how to get started. My DMs are full of people like that. And I love, giving back and just to giving people tips on how to get started. For me, that really, the networking piece, I didn't see as super valuable when I first got into this space and I was kind of doing it on my own. But now, as I've started networking and really getting in touch and building relationships with other people, it's opened up so many doors into business, not just real estate investing, but just like different ways to build wealth and create, wealth for your family.
Yep. Network. You're the network nurse for a reason.
Yeah.
Right?
Well, net worth, but we do have our net worth.
Network, not net worth. Sorry, guys. So that leaves me. Where can people find you? The net worth nurse, right?
So
I got it that time.
Yes, all of our social media under Net Worth Nurse. So Facebook, Instagram, LinkedIn, YouTube, on TikTok, just got that. Oh, just got a Twitter. So I'm on all the socials. Our website's really our main hub. So head over to networthnurse.co. On there, you have access to like everything we're doing. I've been on over 100 podcasts. I have all those on there. I have tons of blogs, courses, community, and coaching on there.
Yeah, and everything you guys have meetings on Monday. It's not Mondays anymore. I think it's Wednesdays, right?
Wednesdays. Yep. We have a Facebook group as well. That's you can get access to that information. Healthcare professionals investing in real estate. It's a really great active group. We host weekly meetings. I have weekly coaching calls on my community-based, my subscription-based membership. So a lot of different ways to get in touch if you're looking to kind of connect.
Actually, I think I'm talking with you guys tomorrow night, the 27th.
You are. Rafa, we'll see you there.
You're there.
Yeah. I saw the thing this morning and I was like, oh, that's right. I got to look at my calendar. I forget what I got going on. So, but anyway, Savannah, thank you so much for coming on. Sorry, Jesse, go ahead.
You just cut me off, Rafa. It's all good. I'm just kidding.
I know. We do this all the time, and I'm like, man, sorry, buddy. I'm sorry.
So yeah, what you guys do, you stream live, and I've gotten so many messages from people that have watched the YouTube video, Savannah, that you put on, and just message like, hey, I'm interested in this, or I saw you on here. So you guys not only just do that, but you also put it up on YouTube for people to watch later on. I think that's pretty cool.
Oh yeah, we're the full deal, full service package.
Full service package. So there you go, folks. Savannah from a nurse down in Modesto at Sutter Gold. And now she's over in LA, which is super expensive. Or not LA, you're in the Valley. Sorry, Southern California folks.
That's LA. I'm in LA.
That
is LA. You're good.
You were correct on that one, Jesse. Finally,
yeah, you need to buy a place outside of LA so you can not have to spend so much money on property, right?
The beach though, I hit that. Rafa, do you hit the beach almost every weekend? Like, I don't know if you've seen the weather outside right now, but it's absolutely beautiful. Sunny and 75 hits in LA. Like, I don't get sick of it. I love it. Yeah. So
I'm a 15-minute drive. So as soon as summer starts, literally I wear hat, t-shirt, shorts, sandals, and I'm at the beach every Sunday, either reading a book or hanging out.
Summer, you hit the beach. Winter, spring, fall, year round around here.
You're right. Absolutely. Yeah, you're right.
You know what? When I come down there, we're going to grab some surfboards and we're going to go surfing, guys. All right. So be ready, Rafa.
Let's do it.
Get your wetsuit together, buddy. So, Savannah, we appreciate you for being here. Everybody listening to this, please like and subscribe to our page on YouTube. Please leave a comment. Talk about what you learned in this episode. Please like and subscribe to our Spotify and our podcast. Leave a review on there. It really helps us, and it's insightful for us to learn if we're doing something right or wrong. But not only that, share this with somebody that you care about, somebody that can get some experience from this episode. Savannah, we appreciate you. It's awesome. I look forward to seeing what you have going on in the future.
Thanks, guys. It was fun chatting.
Thank you.
Savannah, thanks for coming on.
See ya.